Hi, afternoon, everyone. Our webinar will be starting shortly at 12 noon. So meanwhile, sit back and relax while we are starting. Thank you.
Looking for something better than your fixed deposits? What you need is something stable, enhanced and regular. Your solution is the United Income Plus Fund, a fund that offers the best of SER. S. Stabilizer through investing in diversity of bond papers. E. Enhanced performance with up to 30% equity exposure. R. Regular income that has been paying 3 to 5 distributions a year since 2016. Our strategy and consistency make it a class above traditional bond funds, or even its peers in Malaysia, making it the winner of Best Mixed Asset Conservative Malaysia by Refinitiv Lipper. You're one step away from securing a steady, enhanced and regular income stream with United Income Plus Fund. Why settle for ordinary plants? Consider a bonsai today. United Income Plus Fund. Get in touch with us today.
Good day, everyone. Thank you for spending your time with us today for our UOB AM Lunchtime webinar update. Your participations and continuous support has been meaningful to us. Before we start for our webinar today, allow us to share the little joy that we have for some of our awards that we have won recently by our locally managed in-house funds. So awarded by Refinitiv Lipper Funds Awards 2021, we have United Income Plus Funds that won under the Mixed Asset Ringgit Conservative for 3 years. United ASEAN Discovery Funds that won under the Equity ASEANs for 3 years. United Bond and Equity Strategy Trust, Mixed Asset Ringgit Balance Global for 5 years. So apart from the Refinitiv Lipper Funds Awards, we also do won under the Best of the Best Awards 2021 by Asia Asset Management. So the funds that won under this award is United ASEAN Discovery Funds. They won under the category of ASEAN Equities 3 years. And of course, our UOB Asset Management Invest for the category of FinTech Innovations in Asset Management Malaysia. So I'm done with some of the airtime for advertisement for ourselves. The topic for webinar today, Keep Calm and Stay Invested, where we are delighted to have our Chief Investment Officer, UOB Asset Management Malaysia, Francis Eng, as the speaker for today, to talk about his view of the market and how investor can best navigate through this bumpy ride for the road to recovery. So along the webinar, should you have any questions to raise to our speakers, feel free to drop your questions at the chat box below. Francis has been quite well known in the industry, more than 23 years of experience in investment, encompassing equities research and fund management, and joined UOB Asset Management Malaysia way back in 2007. So without further ado, Francis, I shall pass the floor to you. Over to you for your presentations.
Okay. Thank you, Gabriel. Good afternoon, everyone. So we have entitled this talk as Keep Calm and Stay Invested. I think we have seen year to date, there has been some developments in the market, some of which may have caused some uneasiness among investors. So we want to try to address some of those issues. I think specifically, we have seen the interest rates, and I'm referring to the 10-year yields, bond yields, which are one of the key benchmark rates that affects the pricing of most assets. That has gone up. So what does it mean for asset classes? How should we look at it? The other thing, of course, is that we have seen a recent climb in new COVID cases as well. So I'll talk about that as well. Yeah. So I think the conclusion that we have is that these two issues, we think while we should be aware of it, I think generally we are not that alarmed by it because there are mitigating circumstances. Okay, so let's start off. Just to recap, performance year to date March, generally it's been quite good. Most markets they are more in positive than in negative territory. Unfortunately, Malaysia is one which is in negative. I think that's partly because year to date, the gloves, which are a big component of the market, has actually given back some of the gains that they posted in 2020. So just to summarize in terms of the global outlook, we think that global economy is rebounding, and the policies which have been supportive of markets continue to be there. In fact, especially on the fiscal side, the fiscal expansion continues to increase in size, and this is actually good for financial markets. We will also talk about the recent rise in the 10-year bond yields. And our conclusion is that generally the market, especially the equity market, we think will be able to absorb it as long as the inflation expectations are not too high. And for fixed income markets, our view is that the US 10-year Treasury yields, at least for this move, is probably closer to the tail end. So now is a good time to actually start to relook at some of the investments in bonds. So if you look at the growth projections, I think you have seen all this. I think the main takeaway here is that for the advanced economies or developed markets, the rebound is not as strong as maybe emerging markets. And based on IMF's projections, we are only going to probably get back to pre-COVID levels for developed markets sometime in 2022. But for emerging markets, we should get back to pre-COVID levels by 2021. This is based on IMF's projections. This is important. Government policies, which was probably the single largest factor to support markets in 2020, continue to be relevant in 2021, both on the fiscal as well as monetary policy side. On the fiscal, I think the number here looks a bit small, but basically the fiscal expansion is actually equivalent to about 13% of GDP, which is very large compared to the sort of 5% contraction or 4 to 5% contraction that we are seeing in the economy. And this 13% continues to grow. This has not included the most recent 1.9 trillion stimulus approved in the US, and it hasn't included the new infrastructure stimulus that President Biden is talking about, which is supposedly around 2 to 3 trillion, depending on whose estimates you use. Yeah, so the point is that fiscal policy continues to grow. And if you look at monetary policy as well, excess liquidity, if you look at the chart on the right-hand side, you will see that the red line jumped significantly in 2020, and this is actually a function of quantitative easing. And normally that is a very good leading indicator for financial markets. I think the lesson that we have learned in previous quantitative easing exercises is that every time central banks have undertaken quantitative easing, it has generally translated to decent performance for financial markets. Now, for some of the recent events that I think have maybe shaken the market a little, one is COVID cases. It has risen, more so for emerging, some of the emerging markets. We think that the mitigation here will be the rollout of vaccines. It will take time. We don't think it will be a very smooth path, especially for emerging markets. But if you look at countries where they are gaining momentum in terms of the vaccination plan, so let's take the US and UK as a very good example. You can see that the momentum as far as the COVID-19 vaccine is concerned is very strong, and that not surprisingly actually has coincided with a sharp decline in new COVID cases. Yeah, so we think you need to give the vaccines time for it to roll out, and we will get there, we think. And with a more advanced stage in terms of vaccination rollout, we think that that will help to actually keep new COVID-19 cases in check or keep it down. Yeah, but in the meantime, until we get that acceleration in the vaccination program, especially more so in the emerging markets, we might have to deal with flare-ups in COVID cases now and then. So if you look at the progress in terms of vaccination, I think it's generally quite positive. More so for developed markets. I think the projections now is that for most developed markets, they will get to herd immunity by the end of this year. Emerging markets will take a bit longer. We are behind developed markets in terms of the vaccination rollout. So emerging markets will probably get there, we think, sometime in the middle of 2022. Yeah, so until we get there, we think that we may have to deal with periods where there will be rises in COVID cases. But we are not unduly concerned because we think that the vaccination rollout is there. It's just a matter of time. So we just have to be a little bit patient with it. The second issue, of course, is with interest rates. Now, we actually look at past experiences of how interest rates, or in this case, when I talk about interest rates, I'm talking about the 10-year government yields, how they behave pre and post a recession. Yeah. So if you look at past cycles and you compare to the current cycle is the red dotted line. So you can see that the evolution of the interest rates is actually quite in line with what we have seen with past cycles. Yeah. So the point here is that we shouldn't be too alarmed, by what we have seen in the moves in recent times, because you would expect that as the economy improves, in a recession, we cut rates aggressively. When the economy improves, you would expect rates to start climbing. And what we are seeing now is actually quite in line with what we have seen in past cycles. Yeah, so nothing too unduly concerning. And the rise in interest rate, of course, has been fueled by rising inflation expectations. What is interesting is that if you look at what history suggests, if you just look at the equity market, if you look at this bar here on the left-hand side, the bar chart on the left-hand side, it shows you that the equity market valuation, or the PE valuation for equity markets, can generally hold as long as inflation do not rise above 4%. Yeah. So if you look at the bar chart, you can see there, as long as inflation don't go above 4%, you can see that the average trailing PE for the US market can actually hover between 18 to 20 times. It only really starts to become a concern or it gets derated when inflation goes above 4%. Yeah. So we think that as long as the inflation expectations do not rise above 4%, it is okay. Markets, we think, can absorb it. And we are in a period of very low inflation. Yeah. This one, just to show you how inflation rate has evolved, you can see that, focus on the green bars. The green bars are the distribution of inflation since 2000. So in the past 20 years, inflation rate has been largely between 0 to 3%. Yeah, so we are in a period of very, very low inflation. Yeah, and because of that, we think that it is unlikely that we could see inflation go sky high. And if inflation is controlled, even though it's rising, if it's within a tight range, we think that the market can absorb it. There will be some impact, direct impact to the bond market, but the equity market, we think, will be better able to absorb it as long as inflation don't go above 4%. And just finally on valuation, I mean, I get asked a lot of questions about, S&P is all-time high or NASDAQ is all-time high, PEs are actually high and all that. I think we have to look at it. We cannot look at it in isolation. We have to look at it relative to other asset classes. All other asset classes are also, at very high levels. It's not just an equity thing. If you look at bonds, yields have gone all the way down. Yeah. So I think that what is important is that we have to look at it on a relative basis. Is it expensive? Is equities expensive relative to bonds, for example? And if you look at the two major asset classes, it looks actually quite, the two asset classes are actually trading quite in line. So it is not out of whack. Yeah, not one asset class is not necessarily more expensive compared to another. Yeah. So if you just look at the equity yield as well as the bond yield, it does suggest that we are actually trading in line with mean. Okay. So from a valuation standpoint, again, we think that it is not out of whack. Okay, so that will be the last slide for the market. So just to conclude, we think that we are in a recovery. COVID, while it has flared up recently, we think that we are well on the vaccination path, and developed markets will get to herd immunity generally faster than emerging markets. And the faster we get to herd immunity, you can see that number of new COVID cases, especially if you look at markets such as US and UK, it has come off quite significantly. Yeah, and when the cases come down, we will the economy will start to get on the path of normalcy, and so will markets. For interest rates, we think that we are not unduly worried. What we are seeing now is quite in line with what we've seen in previous cycles. And interest rates, we think as long as the inflation rate does not go above 4%, we think that the equity market valuation can generally hold. And we are in a period of very low inflation rate. So we think the risk of very high inflation, we think, is quite remote, given what we have seen. Okay, so in the next section, I'll just touch on briefly about the funds and maybe some of the factors that are very specific to some of the funds. So I start off with United Income Plus. This is a fund where it's 70% in fixed income and up to 30% in equities. So generally more on the conservative end. We can invest globally, And you can see that, I mean, if you look at it year to date, yeah, it's ahead of the benchmark. And if you look at the top contributors, you can see that there's quite a lot of US names there, names like Citigroup, Lowe's. Lowe's is actually a home improvement company. It's like a Home Depot. And then one of our top contributors was also Tencent Music, which is a Chinese company, although it's listed in the US. So generally, the US has done quite well for the portfolio. We think that on the fixed income side, after the recent yield adjustments, we think that is looking more attractive. And as we mentioned now, the 10-year yields are probably around 1.6 or thereabouts. We think that the near-term target for the 10-year yields is about 1.75%. There is our in-house view. So we are getting there, yeah. So we think that it's actually time to start relooking at some bonds as well. And the way we deal with the current rise in bond yields is that we have actually kept our duration quite low. So this has helped to mitigate some of the impact from the recent rise in yields. For equities, we are focused on US market, especially global leaders. And generally, we are quite balanced between growth and value reopening. You can see the top 10 holdings there are generally quite a lot of US names and market leaders in their respective fields. Okay, just to reiterate, as vaccination accelerates in the US, you can start to see some statistics that are showing very positive trends. Okay, you look at it in the last couple of months, restaurant reservations in the US have just gone up. Yeah. If you look at traveling, this is not so much the international, but domestic travel, you can see has already started to increase quite a lot. Yeah. So we like to look at these charts because these are very clear signs that the economy is reopening. And we think that because President Biden has done a very good job in terms of accelerating the vaccine rollout, we think that the US reopening will be faster than initially anticipated. And the other point about inflation, some people say that, okay, because you have all this stimulus going, you give all these checks to people will just spend this money, and because they are spending all these checks, there will be inflation pressure, right? Because there's just so much spending, and they will drive up price pressures. But actually, if you look at what is really happening, this is a survey conducted by the New York Fed. They asked households how they are spending their stimulus checks. So basically, the households are not reckless. If you look at the survey, they are only spending about a quarter of their check. Whatever checks they're getting through the stimulus, only a quarter of that is spent. The rest of it is either used to repay debt or they are saving the money. Yeah. So I think this fear that inflation is going to rise up because people are just going to spend all this money recklessly, I think is a bit overdone, we think. Yeah. Generally, I think the households are generally quite prudent. They are saving money or they are repaying debt. So this money will actually help many of the households to tie over potentially some difficult periods, or when the stimulus eventually is removed or reduced. So for United Income Plus, it's global in nature. we still, US is still one of the key markets that we look at because we think that reopening is going to happen faster than expected. Earnings growth is actually quite robust. The recent reporting season, generally more beats than misses. And the beats are actually by very big companies. For example, most of the FANG stocks have reported and the numbers have generally beaten expectations. So next, we will move on to United Bond and Equity. So this one is 40 to 60% in equities and vice versa in fixed income. Yeah. So here, and this fund only invests in Asia. Year to date, it's actually up slightly over 5%. And if you look at the top contributors, it's a mixture. We have DIY, which is a reopening play. We have Dufu, which is a technology play. We think the growth there is very robust. And Tencent Music, that has also helped the portfolio. Just to take note, we took profit on Tencent Music before the Archegos meltdown. So we didn't, the portfolio didn't really get that affected because, as you all may know, Tencent Music was one of the stocks that some of the investment banks sold as a result of this Archegos meltdown. Yeah. In terms of strategy, we are overweight equities. We think that on a relative basis, equities has better risk reward. Similar to Income Plus, you see that our bond portfolio duration is below average. We are low duration to try to cushion the impact from this rise in interest rates that we have seen for the last couple of months. So if you look at it, a mixture of growth as well as value or reopening stocks. Just for this portfolio, I think this chart is actually quite powerful. What it shows you is that every time we have seen EPS growth in Asia in the last since 2002, whenever we have seen EPS growth, markets, the MSCI Asia ex-Japan index has shown positive returns. Yeah, and this year recovery, earnings growth is actually highly positive. We do expect Asia to post positive returns. That's our forecast. The other thing that has taken some steam off Asian markets in the last couple of weeks is maybe we have actually started to see US dollar strengthen. Actually, this is against most expectations. I think at the start of the year, most people thought that the US dollar will weaken. But in recent weeks, it's actually strengthened. Our view is that we think US dollar is still in a decline. But even within the decline, there are periods where you may see bear market rallies. And I think this is what we are experiencing now. The other chart that we have on the right-hand side, which is actually quite interesting, is that this actually tracks the short positioning in US dollars. So as you can see at the start of 2021, when I think the market was generally quite negative on US dollar, you can see that the short positioning was actually quite extreme. Yeah. So what's happened now is that the short positioning has narrowed. And I think this also means that, the market is a lot more balanced in terms of its views now. And so US dollar in terms of strengthening further from where we are, we think is a lot less. And if you also take into account that President Biden might want to continue to stimulate the economy, this will have impact in terms of budget deficits, and this will be generally negative for the US dollar. Okay, and just in terms of valuation, Asia is still relatively cheap relative to global valuation. And just finally, on United ASEAN Discovery, this is a fund that is pure equity, invests in generally mostly small mid caps within ASEAN. Year to date, the fund is up. In terms of top contributors, a mixture of tech and some reopening stocks. ASEAN, as I mentioned before in my past presentations, we think that ASEAN is a reopening play. Excuse me. In terms of stock market representation, it is very skewed to reopening sectors. So we think that ASEAN will do well. ASEAN will do well when the reopening is in full steam. Yeah, so what we have seen recently is that COVID cases have risen in some ASEAN countries, and that I think has caused the market to lose a little bit of momentum. But we think that if you look at it on a 12-month basis, we do expect the vaccination pace to pick up. And when that happens, we think that the markets will also reflect that. Yeah. And the other thing is the US dollar, what we think is a bear market rally, has also been a bit of a headwind to all emerging markets, including ASEAN. We think that going forward, this bear market rally is likely to moderate, and because of that, there's less of a headwind for emerging markets, including ASEAN. Yeah, as I mentioned, you can see that ASEAN is very tilted. If you just look at the chart on the right-hand side, on the right-hand side, yeah, ASEAN is very heavily tilted to value or reopening plays, whereas markets like China are very heavily tilted to growth plays. Yeah. That's the end of my presentation. I'll be happy to take any specific questions you have on the funds or on the markets. Yeah.
Okay. Thanks for the presentations, Francis. For more information on the funds, on the three funds that Francis has presented just now, feel free to download their fact sheets under the file handouts in the webinar. So yeah, now let me start the ball rolling with some of the most commonly asked questions for the three of the funds that you have shared, or some of the markets, the view that the investor that they would like to ask. So let's start off with United ASEAN Discovery Funds. The fund, as we all are aware, is largely outperformed its peers with the returns of 28% way back in 2019, 41% last year, 2020, and subsequently won some of the awards by Refinitiv Lippers and also Asia Asset Management. So could you share with us on how do you do the cherry picking for your active stock pick strategy for the funds? In fact, if you look at some of the major indices across ASEAN region, they are pretty flat across the year. And some of the ASEAN countries like Thailand, Philippines, or even us in Malaysia are still struggling with the rising COVID cases. So yeah, what's your comment?
Okay, maybe I address the first part first. How do we cherry pick? So we are quite fortunate because we think that our presence in ASEAN, we think, is unparalleled. And last year, we have market representation. I mean, we have representation in all major markets in ASEAN. We added Vietnam recently, and over the last 12 months or so, we have also started to build our presence in Indonesia. Yeah. So with that presence on the ground, I think it helps us to get local insights, and you need that because you are buying into small mid-cap stocks. So having the presence on the ground gives you an advantage over your competitors, which are probably some of them doing it, from Hong Kong or from Singapore. Yeah, so that we think is a key advantage, and also our research focus, because we do most of our research in-house. I think we are very focused in terms of getting our excess returns for clients. Yeah, we don't just do research for the sake of it. We do research to try to uncover what we think are mispriced opportunities by the market. I mean, I can talk about this, but I think the numbers they are evidence that the processes we have in place, I think, helps us to generate helps us to identify the ideas and helps us to execute them and helps us to generate the performance numbers that I think you talked about. So the second part of the question was about how ASEAN markets have the momentum has weakened recently. So let's rewind back, right? So if you look at it towards the end of 2020, ASEAN markets actually did very well. The moment the news of the vaccine came out, ASEAN markets popped immediately, right? Because investors immediately saw that, ASEAN is the reopening play, and they just started to move money into ASEAN. And right up to then, ASEAN markets had not really done very much. Yeah. So fast forward to today, that momentum has somewhat weakened because the COVID cases have increased in certain countries, including Malaysia. We had to deal with MCO in the earlier part of the year. We are out in CMCO, but again, cases have started to rise. So we think that over the next 12 months, unfortunately, there will be we think that there will be flare-ups in cases every now and then because we haven't achieved herd immunity yet. But if you look at it on a 12-month basis, we think that we will get there in terms of herd immunity, or we will get to very high levels in terms of vaccination. And when the vaccination gathers pace, we expect ASEAN, which is a reopening play, to start to reflect that, like exactly what we saw towards the end of 2020. So I think what we do now is that we think that this current market lull, if you like, will actually give you time. Yeah, will actually give you time to accumulate. We have some cash holdings in the portfolio, so we are taking this opportunity to actually add to our positions. Because we take the view that over 12 months, herd immunity will be there, or we will get there. And when we get there, we think that the interest will come back to ASEAN, just like we saw in the end of 2020. So I think it's better to take do the hard work now, position now, and then be patient, rather than wait for the money to come in, and then you chase later on, and then you may have to pay a higher price.
Yeah, that's very true. Don't chase the market.
Yeah.
Okay. One question from one of our investor here. Because our ASEAN Discovery Fund, we have large of the position in Indonesia. So they are curious to know why Indonesia is an attractive investment destination. And recently we saw news on the new sovereign funds sovereign wealth funds that has been set up in Indonesia. And what is your comments on this, whether it is affecting the Indonesian markets or any effects to our ASEAN Discovery Fund itself?
Okay, maybe I answer the second part first. I think the setting up of the sovereign wealth fund is a positive step. I think besides that, there are other reforms happening in Indonesia, which I think will put the market in a good position, especially over the medium to longer term. And if you look at the underlying fundamentals of Indonesia, if you want to invest in ASEAN, this is probably one of the most lucrative markets to invest in. Rising middle class, huge population to begin with. And we just see a lot of opportunities there. Yeah. So if the reason why Indonesia is our largest position is that, or quite close to our largest position, it's neck to neck, I think, with Malaysia. Towards the end of 2020, we increased our Indonesian positions quite significantly, because we think that Indonesia is, given the valuation, we made the call that it was the best reopening market to buy. Because many of their stocks were actually trading at very, very attractive valuations. Companies with like banks, their consumer companies, and Indonesia has very good representation in commodities. We are able to buy quite a lot of mining companies and all that. We made very decent returns in it as well. So these things we think will do well in a reopening. And Indonesia gave us the opportunity, and the opportunities were available at very lucrative valuations. So that's why we ramped up our Indonesian position substantially. Yeah. In the near term, we have taken some profits off Indonesia, and we are relooking, right? Because some of these prices I think have retreated a bit. So we are relooking to put some of the cash to work in Indonesia and other markets. Yeah.
Okay, thanks. One more questions for ASEAN Discovery Fund. I think this question has been raised, by many of our investors. Of course, I think just now you have covered part of it, is regarding on the current strengthening of the US dollar on a short-term basis. Yeah, so were this strengthening of US dollar a headwind to ASEAN market or to the extent emerging markets, and what is the impact to the fund itself, short-term or medium-term? Yeah. Okay. So maybe I answer. Medium-term, we think that US dollar is in a weakening trend. I think let me see. I think I think I have the chart here, but just help you all to recap. Yeah. So medium term wise, we think the dollar is in a downtrend. But we did mention, I mean, we do think that even in a downtrend, there are periods where, you could have what you call bear market rally. So a rally within a longer term bear market. So we think that this is exactly what's happening now. We take some comfort. We think that this bear market rally has probably, most of it has already taken place. If you just look at the positioning in US dollars, the short position has actually narrowed quite substantially already, if you look at the chart on the right hand side. Yeah. So I think expectations now are probably a lot more balanced. And because of that, we think that, the market is probably less likely to get caught off guard by a bear market rally. Because what happened in early 21 was that the positioning was like just very extreme, right? All of us thought
US dollar was just going to continue to weaken. Yeah. So the positioning now is a lot different. So we think that generally the bear rally, at least this round, looks largely done. And as I think most of the audience, you all know that generally emerging markets do better in a weakening US dollar environment than a strengthening US dollar environment. So we think that the factors to support a weaker dollar, I think, is there, especially if they continue to spend on fiscal, and Biden is talking about another infrastructure stimulus package, right? Just after the 1.9 stimulus, and you know that countries that sustain deficits tend to have it tends to be followed with weaker currency. Yeah.
Thank
so
you.
we think it's at the tail end and less of a headwind, not only to ASEAN, it's also to Asia. All emerging markets, we think, will benefit from less headwind from US dollar. Yeah.
Sure. Right. Let's move on to United Bears Fund. So we noticed that the fund has been performing relatively well in the recent year. 16% way back in 2019 and 19% last year, 2020. So, and year-to-date performance, of course, is close to 6% as of now. So despite this is just a balanced fund. So could you share with us what has done well that really contribute to your outperformance of the fund?
Okay, I would say that two main things. I think research continues to be a cornerstone for our investment, our investment processes. So through our research, I think if we find differentiated ideas or companies where we think we have we think that it is not correctly priced or inefficiently priced by the market, we are not scared to take a very active position in such companies. So that one definitely helps us. I think the other one is asset allocation as well. I think for this fund, we can go between 40 to 60%. So in the last couple of years, I think we have generally been overweight equities, and I think it has been the correct call. Equities have generally done better over this period, so that has helped us. So if you look at specific what really contributed to the positive performance, so I think in 2019 I already shared with you which were the top. So these are some of the top contributors. So in 2020, technology definitely helped us. Things like, I'm trying to recall, Tencent, TSMC, many of the Malaysian tech companies, which are mostly hardware-related type companies or semiconductor-related type companies, those actually contributed to performance. And we also had a little bit of a boost from gloves, right? Last year, Malaysian gloves did well. Not only gloves, I think we managed to get exposure to the glove within the big four glove stocks. We managed to get exposure to the best performing glove stock within the big four glove names in Malaysia. So that definitely helped us. 2020 was tech as well. Tech has been a sector which we have been overweighting for the last couple of years because we think that there is a very good secular story. So we think it's not short term. We think it's more medium to longer term. And these are the sort of things we like. because you can just buy, hold them, and the earnings growth and the re-rating will help to get you the fund performance. Yeah. So tech, the 2019 definitely was quite a big contributor. Indonesia, I think in 2019 also helped us quite a bit. We had exposure to banks, consumer, construction. So those sectors in Indonesia, I think generally did well for us. Yeah. So at different points, I think different sectors or different companies, I think contributed to the performance. But I think we are constantly looking for what is the next best thing, you know, to populate the portfolio to get excess returns.
All right. Talking about the sectors, right? So I saw one of the questions coming from our audience. So just now we're talking about the sectors regarding tech, healthcare last year, way back in 2020. So which are the sectors that you think is uprising coming onto this year, 2021? Or the sectors that caught your attentions that you might overweight in 2021 this year?
Okay, so we still like tech. We think tech is a secular story. So this one we think has years yeah, in terms of legs. I mean, I think it's very cliche, but you know that there's just rising adoption of technology in our everyday lives. Yeah. So that helps to underpin the demand for anything that is tech related. So that one is there. We like some of the reopening plays like property, real estate. We think that those things will do well when we get to a reopening scenario. So property will be things like retail. It can be REIT. It can be it can be even retail-like businesses. So something like a Mr. DIY, for example, right? This will benefit if people are more comfortable coming out to do their normal shopping. Yeah. Okay. So things like that. We like the consumer business. That continues. Again, consumer is very linked to reopening. So when we are less, once we get vaccinated, we are less fearful of coming out. So that will help to underpin better consumption trends. And of course, financials. Banks actually benefit generally in a rising rate environment. Spreads go up. The other thing, of course, is that economy is recovering. When economy recovers, you are less fearful of all these, provisions for NPLs, etc. So all the headwinds which we saw for the financials in 2020 will start to become tailwinds, right? Whatever you have provided, maybe you over provided. Now you start to release some of these provisions. It will help to improve the earnings trends for banks. Yeah.
All right. Okay, let's move on to United Income Plus funds. So the funds actually garnered a lot of interest from our hardcore FD clients, those clients that really die hard, want to put the money into the FD. But because in the recent year, the interest rate environment, which is very low, so they started to cash out their FD and put into United Income Plus funds, where they could enjoy quarterly distribution payout while enjoying the potential capital appreciations on the funds. So conservative investor like this recently has been concerning on large part of US equity exposure of the funds, which is 15% out of the total equity exposure of about 26%. But I think just now we have covered partly on why we are focusing on US, because the vaccinations rates, things like that. So, and of course, there are also concerns that U.S. market are hovering at the all-time high level. So, do you want to re-emphasize again on your pointers to them on why we are having such exposures to U.S. market?
Okay. So United Income Plus Fund, as you may be aware, has a we can invest globally, right? So all markets are open to the fund. So if you just look at the equity portion of it, actually the US exposure is quite in line. Why I say that? If you look at any global market index for equities, so let's take MSCI AC World, MSCI All Countries World Index. I think US is in the high 50s, in terms of the world index weighting, right? So the exposure that we have, which is slightly over half, is actually quite in line with the US market representation within global markets. So it's not some, basically it's quite in line. Okay, so that's one. I think generally we are quite positive on the US. I think the factors you mentioned. Just to recap, vaccination faster than expected. I think they will get the normalcy faster than expected. Corporate earnings very strong. In fact, surprising markets on the upside. And because we like tech, and whether you like it or not, many of the global tech names are all listed in the US. Even some of your big Chinese names are also listed in the US. Yeah, so it's not something that we can ignore, right? I mean, and you know that in the tech space, the winner takes disproportionate market share, right? We don't search for something, we Google for something, right? Right? Search is synonymous with Google. That's how powerful it is. Yeah. So because of that, that's why we have US exposure. And the other thing is that some of I would say quite a lot of the names that we bought in the US, some of them may not be at record levels, although the market is at record level. They haven't reached that yet, but we think that over the next 12 months, it is possible that these stock prices could reach record levels. And for some of them, they have reached record levels. I think we think that as long as the earnings momentum is strong, and it is, we think that it will continue to be able to support the sort of valuations. I think many of the companies that we have, we think that let market valuation aside, we think that on a standalone basis, the valuations do hold up. Yeah. So we are not that like I said, we are dealing with global leaders, and I think you've seen some of the FANG stocks, the profits only doubled in the latest quarter. Their profits doubled. Okay, almost doubled. Yeah, so I mean that's the kind of power we are talking about. Yeah.
Okay, thanks. I think we have one last questions from the audience talking about US just now. So we know that Biden would like to have a tax hike to fund all the infrastructure spendings that he would like to tack it on. So how do you think this tax hike is going to affect the equity market? Your comment.
Okay, a tax hike we think will be generally net negative for markets, simply because if let's say that he decides to raise corporate taxes, If you raise corporate taxes, then immediately your EPS will come down. EPS come down, PE goes up. Markets will probably adjust for that. Yeah. So that we think on as a whole is net negative. We think it's very early to try to assess the impact of it because you do not know, where is he going to hike. I think the recent one I've read is that he's looking to hike taxes for the richest people, which, you could say is quite fair. Yeah, to pay for some of the programs that he has in mind. There's also talks about capital gains tax. This again will be net negative for markets. The other side of it, which I think not many people focus on, is what is the likelihood that he can push through a tax increase? Okay, the plan is fine. Now, when you actually try to negotiate and try to increase taxes, we think it may not be so easy. The Senate is, the US Senate is very finely balanced, 50 on each side, with VP having the casting vote, right? And I don't think it's a sure thing that even all Democrats will vote for it. Yeah, it's not a sure thing, I think, yeah, because within the Democrats, I think there are some more conservative leaning type Democrats. They may not necessarily vote for an increase, or they will try to, in the debate, in the discussions, there may be some watering down. Yeah, so I think that I wouldn't assume that the tax hike is a sure thing. Yeah, it may face political opposition. Definitely from the Republicans, tax hike is a no-no. I think for them is very, very clear, right? And if they delay the process of this tax package, we are getting midterm elections in 2 years' time, right? Things can change. Republicans may gain back control, or they may increase their representation in government. And if they suddenly get back the majority, that's it. I think the taxes may not happen. Yeah. So okay. So in conclusion, if it happens, net negative for market, but we do not know the extent, how much taxes will increase by. But I think the more important thing is, why are we so sure that the tax increase will come? Right? It may face political opposition. Yeah, we shall see. I think, yeah, my point will be, why are we so sure that the tax increases will come? Yeah.
Okay, in general, to summarize it, it can be still too preliminary to talk about the tax hike. And it won't be easy, even though some of the Democrats, those conservative Democrats, they also wouldn't want the tax hike to go through. All right, so I think we have come to 1 p.m. in the afternoon. So time's out. Thank you, Francis, for your time with us today, for the presentations and for the Q&A sections. Appreciate it very much. So I think we have come to the end of our webinar today. So I think, any final question, any final advice to the investor before we end the webinar, Francis?
Keep calm and stay invested. Rates are very, very low. I don't know, money needs to find a home. We think that, the alternatives like equities or fixed income and all that, I think there is still a case to be made.
All right.
Stay the course, because government policy is still very supportive of markets. We will start turning more cautious when policies are less supportive of markets.
Yeah, that's why our webinar topic for today is keep calm and stay invested, which summarize everything of our webinar for today. Yep. All right. Thank you very much, Francis, and thank you very much, everyone that joined us today. So it comes to the end of our webinar for today. Thank you very much. Stay safe, everyone, and bye-bye.
Bye. Thank you.